The first thing I want to show you is the standard 30-year fix, right? Right now, of course, based on our rate grid you saw earlier, 30-year loan, no points, 5 7/8, $500,000 loan amount. What's your principal and interest payment going to be? $2,958. Now, over the life of the loan, the full 30 years, you would incur $565,000 just in interest cost. So, of course, the argument with a lot of folks will be, well, wait a minute, I'm borrowing $500,000. I've got to pay that back, and then I got to pay $565,000 of interest as well. I'm paying more than double my loan amount in interest. Oh my gosh, that's terrible. Well, that's true. But let me give you a little hint. I understand that analysis. Yeah, it's worth considering. Yeah, you should be aware of it. I will tell you that in a majority of cases, you'll never incur that $565,000 of interest. The reason? Because a majority of borrowers, when they get that $500,000 loan to purchase a home, particularly if it's their first home, the probabilities are you're never going to pay that 30-year loan to term. You are not going to make 360-month payments and still have that house 30 years later that is now free and clear. In a majority of cases, particularly in California, that is a rarity anymore. In fact, the average life of a mortgage, in terms of what in the industry technically is called prepayment speed, it's more like 7 to 10 years is the average length of a mortgage before it's paid off. And of course, it can be paid off because you're selling your home, because you refinance the loan, maybe a couple of times if rates keep dropping. There's a variety of reasons. You win the lotto and you just want to pay it off. There's a variety of reasons why in a majority of cases, when you get that 30-year mortgage, you're not going to pay the full 30-year term. That's very, very unlikely. So don't get too worked up about that $565,000 of interest that you're going to incur if you make all 360 payments.